Hello there, everyone, and welcome to today's PAC webinar. So excited you are here. Sorry, we are starting a few minutes late. God bless Tech Gods for giving us yet another challenge. That is how things tend to go sometimes when you're doing things live. So thank you for your grace as we get this rolling a few minutes late here. So I am very excited to have you guys here today. We are actually going to be talking with Ashlee Moore. She is actually the pet loan officer for the First National Bank. And the beautiful thing that she is able to do is bring us the latest information, especially when it comes to SBA loans. Now, I don't know about you, but this is something that has always very much confused me with the regulations. I know there are many of us in the pet care industry that are looking to expand right now or even get something completely new started. So this is really going to be exciting for us. But first of all, I wanted to share a little bit of information for those of you that might not be familiar with the Professional Animal Care Certification Council. We are hosting this webinar for you today, and just wanted to talk a little bit with you about the opportunities and how much PAC can actually benefit your own pet care business. Now, our mission is really to bring independent testing and certification to the pet care industry. We are not a group that will teach you the hows and the whys. We are a group that is going to provide the testing to make sure that you can demonstrate you have the knowledge. You have standards that you follow in the industry. And this is considered your third-party certification. We don't teach and test. We actually test you on your current knowledge. So it is a true independent certification for you. When you do pass one of the 3 levels of testing that we have, you're demonstrating that you have a really broad base of knowledge, and that does come with a 3-year certification with that. So we do have 3 different certification levels. The first one is for your general provider level. So that's going to be somebody that is out providing care directly to the pets. That's going to be somebody that is actually working in the yards at your boarding and daycare facility. We have the Certified Professional Animal Care Manager. That is going to be your management level on your team. And then your professional animal care operator is typically going to be that person who is the founder, who started the business, who is making all of those big decisions as your business scales and grows. So these 3 different levels have their own amounts of requirements to be able to sit the test for each one of these levels. So of course, why PAC? As I mentioned, we are the only third-party certification for the pet care industry, which is an amazing thing to have, to be able to demonstrate to your community the level of focus that you do have on your own standards and standing up for what you believe is right for pet care within the pet industry. PAC is really important for your business because if you look at it, most of the professions out there do require some sort of independent certification. Not just, learn and demonstrate your knowledge by taking a test so we can slap a certification next to your name, but it really shows that you're staying relevant, you're staying competitive, you're staying up to date on what general practices are in the actual industry. Having this available to your employees to go ahead and prove, of course, their knowledge can absolutely bring in higher quality of employees, build your employees, help you, of course, turn them into leaders, and then develop that trust level with the pet parents in your community by demonstrating, of course, how your entire organization is willing to stand behind your knowledge. Just want to let you know, we do have, of course, only one opportunity left to take this exam in 2024. There is a registration, or there's a testing window, which is November 9th to the 23rd. You do have to register by October 13th to take your test during this window. The test is available, of course, at testing locations everywhere and you can also do it remotely by proctor. We have an excellent study group. Of course, you can go to the PAC study group, find out more information, and of course, you can message us if you have any questions about either taking a pre-test on getting certified yourself or being certified. So I am very excited, so glad that we could come to you today with this information and additionally have Ashlee here to talk to us. So I am going to go ahead and bring her on without waiting any longer. Miss Ashlee, hello there.
Hello.
Thank you for joining us here at PAC.
Thanks for having me.
Wonderful. So I'm going to let you go ahead and introduce yourself.
Yeah, so my name is Ashlee Moore. I'm sure I have probably met plenty of you at previous conferences and events, but I am the pet care loan officer with First Financial Bank. So I specialize just in the pet care industry. I work with people just like you on business acquisitions, expansions, really anything that you need. So really here to be a source of information and a help for you guys as you navigate ownership or whatever the case may be for you. Love to be a wealth of information. So why I'm here today.
Wonderful. So now about the slides, do I need to do the slides for you or were you able to get?
Unfortunately, it's looking that way.
That's totally fine. Totally fine. So I'll be over
difficulties.
I guess a little housekeeping for those that are watching. So I'm going to be doing the slides for her. I don't know if you want to rub your nose or tug on your ear when you want me to change slides. Tell me to. I'll try to be predictive here.
Well, we'll just keep that.
We'll do the best.
Next one.
Wonderful. And otherwise, I am going to watch over in the comments. Anyone who's watching, if you have any specific questions for Ashlee, drop them over here. I'm going to be the Thelma to her Louise. And then once we get to the end of the presentation, I'll bring some of those questions to you, Ashlee. All right?
Perfect. And if there's anything along the way that keeps coming up, definitely let me know. Happy to address it so we don't lose our place.
Will do.
Lose our
all right. Perfect.
All right. So yeah, today we're going to talk about some different things with SBA loans, and you can go ahead and go on to the next slide there. Yeah, we're going to talk about the SBA guaranteed loan programs. What is out there for you? What is there depending on your business type, your business needs? What options do you have when it comes to small business lending? We're going to talk about the actual application process itself, because sometimes I know that can be scary, right? Looking at all of the different items that are needed. How long is it going to take? There's a lot of questions surrounding it. So we definitely want to make sure that you're armed with that information. So when the time comes, you're ready to go. And then also there have been some recent changes in the SBA lending process and some of their rules, important ones that can impact your ability to borrow and kind of in a lot of ways made it more friendly to people entering into this space. So definitely want to touch on those changes and see, what kind of impact it can have on each of you. So let's get started. All right. So some things that I wanted to share about the SBA guaranteed loan programs. One thing that is a common misconception is that when you get an SBA loan, you're getting money directly from the SBA, the Small Business Administration. That's actually not the case. They set the guidelines, the rules that the banks have to follow to lend SBA loans. However, the bank is actually lending the money. So it's just like any other loan product that you are getting from a bank. You are borrowing directly from the bank. The SBA is just guaranteeing that loan so that the bank feels more comfortable for different projects. So, for example, when you get a conventional loan directly from the bank, a lot of times there's going to be higher down payment, cash injection requirements. They're going to be a little bit more stringent on the rules. The SBA, with their backing, gives us a little bit more, wiggle room when it comes to what we're able to lend on. So with some of that uncertainty, we're able to go forward with some of those projects, especially with startups and things like that. It's structured according to the SBA requirements with that SBA guarantee. So they'll have anywhere from like a 75 to 85% guarantee should something happen. But we do have to meet all of their requirements. So For example, you might have gone through the SBA process and been like, why do I need all of this paperwork or all of these details? And because we got to follow their rules, basically. And that's information a lot of times that is put forward by the SBA and a lot of requirements that are put forward from them. But what's interesting, you can have, most banks, a lot of banks rather, do lend SBA loans, but there is something called a preferred lender participant. And what that is a bank that has done, a certain number of SBA projects where the SBA feels that they are knowledgeable enough to be a preferred lender in that space. So when you're looking at different banks to go with for SBA loans, somebody who doesn't have that designation might not do a lot of them, might not be as familiar with the process, and they actually have to send those in most times to the SBA for their thumbs up. A preferred lender doesn't have to do that in most cases. So some of those horror stories that you hear about it taking 6-8 months, whatever the case may be, up front, a lot of times that would be, those banks would not have that PLP designation. So you definitely want to watch out for that when you're looking for a lender to go with. So the SBA size standards, in order to be able to get an SBA loan, you have to be defined as small by the SBA. What does that mean? So the SBA uses they're called NAICS codes, NAICS, for each type of business. So whether you're a smoothie shop or a retail store or a pet care service facility, you get a different NAICS code. And those NAICS codes each hold the standards for what is considered small. So each business, depending on what it is, will have a different set amount that they're able to produce on average to be considered in that designation. So it either goes by number of employees or average receipts. And usually that's off of the past 3 years of receipts. If you're looking at doing a startup or something like that, it is based off of your first 3 years of projected income. For pet care, that NAICS code is 812910. If anybody is interested in looking that up and seeing what all their standards are around that. There's actually some very interesting data about industry averages and things. If you do look that up online, it's pretty cool. But so that NAICS code is based off of their small business standard is based off of your annual gross income. Now, that size standard in pet care is actually 9 million. So what that means is across all of the facilities under one business. So if you're a multi-facility owner or anything like that, in most cases, if you are under that $9 million mark, you're still considered a small business. If for whatever reason you would exceed that $9 million mark and still be interested in a small business loan, in some cases, the SBA does allow us to do some sort of equation to find those standards. But a lot of times, in most, single units and things like that aren't going to exceed that $9 million mark. All right, so let's talk about the loan types that you're able to get. So our bank, we mainly work with the 7A program. And there are two different types of 7A loans. There are small and then there are standard. So small actually is anything up to $500,000. So it's funny because, talking about $500,000 as being small seems a little bit silly, but anything up to $500,000 would be considered a small loan. It can have a little bit easier of a process. It will be pre-screened by the SBA and has to pass their credit scoring system. So with that, it's just the actual business's credit that impacts that credit scoring system. So the standard loans are anything above 500,000 up to 5 million. Now, when looking at these businesses and evaluating them, these must have a debt service margin of 115% or higher. If you don't know what debt service margin is, it's actually your net income. So once all debts are paid, all of that, what is left over to pay that debt, we want to make sure that it's 115% of that total debt or higher, basically. So you're not, cutting it too short when it comes to that debt service. Some other options that the SBA does provide are 504 loans. Now, these actually can go up to $5.5 million, and usually these will be on major construction projects. If you're looking to just construct a building and all of those things, if you're purchasing a new one or land or anything like that, these cannot include things like working capital, inventory, refinances, anything like that, whereas the 7A can. So if you're looking to, do a startup or an expansion or something of that nature, that 7A will allow you to put all of those pieces into one loan product. So you're able to get those operating expenses through working capital. You're able to get, furniture, fixtures, equipment, anything you really need to finalize that project. Another option that's interesting is an SBA Express loan. Now, this one is up to $500,000, but has a lower guarantee than the standard and small 7A loans. This one is 50%, and it does have that $500,000 aggregate limit, which means that you can't exceed in all your loans $500,000 in that Express product. We can go to the next one.
Yes. So I'm going to pop in here just for a second for a few clarifying things for some people who might be new to the entire concept of lending within the industry for expansion. If you wouldn't mind just humoring me here and explaining a little bit better the 75, 85, 50% guarantee.
Absolutely. So those guarantees are the portion of the loan that is backed by the SBA. So, for example, if you take $1 million out and something were to happen with that loan, unfortunately, the SBA would back up to $750,000 if it were a standard loan. If it was a small loan, that would be $750,000 to $850,000, and for those express loans, it would be 50%, so up to $250,000 if it was that $500,000 limit. So that's where when you're taking out these loans, that's why the banks are able to lend a little bit easier, because they do have that backing. There is that guaranteed amount that limits the exposure for the bank itself.
Perfect. Are you going to be talking about like collateral and things like that in this presentation?
I believe so. Yeah.
Okay.
But if it's not on one this, we'll talk about it for sure.
Well, yeah, we'll catch that in the end. And then that DSM, just to put some numbers so I understand it a little bit better. So if we just use, because I'm really good at visualizing with numbers. So if we're looking at having a loan that maybe has a monthly debt servicing of about $10,000.
Yeah.
So are you saying that it needs to be 11,500 is the profit?
Yes. So yeah. So you just want to have at least 15% over that debt. So for example, and we do it on an annual basis because it's understood that monthly, things fluctuate, right?
Yeah.
January, February, you're probably looking at that P&L is a little tighter than July and August, right?
Mm-hmm.
So we do it on an annual basis and we go off of the 3-year average. So basically, say for example, your annual debt is $100,000. You want to have at least $115,000 to be able to pay that debt off. Preferably, you want to have a little bit more wiggle room than that, but that is what we consider manageable in the repayment realm.
Wonderful. Thanks for sharing that.
Of course, I appreciate it. Awesome. So let's talk about loan term and maturity of the loans. So there are a couple of different ways that the actual loan term is determined with these SBA loans. So the SBA allows us to finance up to 25 years on these loans if they're secured by commercial real estate. So here, collateral, right? In 10 years on non-real estate secured loans. So what that means is if you have, say you're purchasing the real estate of real estate and business assets of a project, we can go up to 25 years if you have that real estate within that deal. But say you're purchasing just the business and it's a leased space, that one has a limit of 10 years. So when we talk about, the real estate and adding it in, there is definitely a benefit to having it if that is an option for you, because it does extend out that loan term. So in reality, a lot of times what happens is your overall monthly payments are lower because you don't have to pay rent to somebody else, and your term is over that 25-year extended period in a lot of cases. Sometimes a blended term is required, and that would happen if the business assets, exceed the cost of the real estate. So say the business assets are 600,000 and the real estate is 400,000, then we would use a blended term of up to 25 years. So if at least 51% of the use of proceeds in the loan, so with everything added in, is for that real estate, that 25-year term applies. If it's less than 51%, then we do that blended term. Usually, we come out to 15, 20 years, something like that. But it would be project dependent and dependent on how much of that. So if it's 45% is still real estate, we're going to get closer to that 25-year term than if 20% is real estate. All right, so this is actually really exciting. Historically, we do have SBA guarantee fees, loan fees on the projects, and that is just for the SBA to provide those guarantees for us. Historically, it was originally a flat rate across all loan products. That didn't matter what the size was, and then it started at $1 million or $500,000. Now, any loans less than $1 million do not have a guarantee fee, which is super exciting, especially if you're starting a new project. It can be tens of thousands of dollars. So anything under $1 million, that fee is not there. Anything of $1 million to $2 million, it is based off of the guaranteed amount. So you get a 75% guarantee. So if it's, $1 million, it's based off of $750,000, but it's 1.45% of the guaranteed portion up to $1 million, then 1.7 of the guaranteed portion over $1 million. So, for example, if it's 1.2 million, it would be 1.45% of that, or 1.2 million of guaranteed money, 1.45% of that first million, and then 1.7% of 200,000. So that's something we can figure out within the loan. Don't expect you to if you're bringing a project to us off the top of your head, but we'll work together to figure that out. Now, for loans over $2 million, up to that $5 million mark, if it's over $2 million, so it would be 3.5% of the guaranteed portion up to $1 million, plus 3.75% of the guaranteed portion over $1 million. Now, the percentages are based off of the guaranteed portion, the amount that you have. So the actual 3.5 or 1.45, those are based off of the overall loan total. So the actual what you're paying is based off of the guaranteed portion, but the percentages that we use to figure it out are based off of the overall loan total, if that makes sense. Be a little tricky, but they definitely are better than they have been historically. All right, so let's talk about the elephant in the room when it comes to these projects, and that currently would be the interest rates. So I think over the past several years up until recently, we've been very lucky, very fortunate when it comes to these rates. I know I myself and my mortgage lender called me and said, hey, you want to refinance to 2.5%? I was all for it. So, we got very used to those 2.5%, 3%, 4% rates. However, those, obviously have gone up. So right now, prime is at 8.5. And what that means is, your rate for your overall project is likely going to be a little bit higher than that. However, if you look at it actually more historically, beyond just the past, 5 or so years, 8.5 isn't crazy high. It's actually around the average. The prime rate in 1980 was 21.5. So much higher than what we're seeing now. So yes, we've seen, better rates in the past. Hopefully we will get some improvements there over the next couple of years. We're fingers crossed for that. But we want you to be prepared, not alarmed by these rates. So if you have a good opportunity in front of you, that 8.5 prime rate, if it's a good opportunity, you should still see cash flow off of it, and hopefully that those rates will improve over, in the near future. So again, be prepared, not alarmed when it comes to these rates. All right, so let's talk about the loan process start to finish. And I always say when I'm looking at this, phase 1 through phase 5, where you're finding the business that's right for you and you're getting that letter of intent, or if you're doing a startup or construction or anything like that, getting those construction bids. And for those projects, that takes the most time. Sometimes that can even take years. And, I always encourage people to be very cautious, make sure you're finding the right business for you. Don't rush into anything that you don't feel 100% comfortable with, because it's definitely not worth it in the end. Take your time with this part. So it can take anywhere from months to years to get from phase 1, where you're actually finding the facility that you want or coming up with the plan that you want, to getting that LOI out there, that letter of intent. Once we get through that phase 1 to phase 5, that phase 6 through phase 8 happens much more quickly in most cases. So usually from the time we receive approval for financing to the actual closing of the deal, that takes roughly 60 days, give or take a little bit. So if things move smoothly, we get everything rolling around 60 days. We do things a little bit differently than some others, where we actually receive that approval up front in the underwriting and process, due diligence process, rather than at the end. But yeah, from that point to the actual closing is about 60 days. All right, so let's discuss some of these updates that will have an impact on lending, and kind of the procedures and things that you guys are seeing or will be seeing when you go to do any type of SBA lending. The goal with a lot of these was to streamline the processes and help make these loans more accessible to a lot of people. And I think you'll see that in most cases, they really did make some of the bigger hurdles that people face when getting into business. They did ease up on them a little bit and make it a little bit more accessible. So, things from the equity injections to those guarantee fees that we talked about, and all of that. But yeah, let's go right into those equity injections. All right. So historically, with the equity injections, there was pretty stringent rules. Before, it had to come from your savings. We had to see 2 months of bank statements. It couldn't come from certain places. If you got it from somebody else, it had to be gifted, couldn't be paid back. There were a lot of rules surrounding it. And whereas, you still can get it from those sources, one of the major changes that they made was in the conditions to seller notes as down payment. And what a seller note as a down payment is a secondary loan that the seller of a business will carry as part of their overall compensation. So say, the loan is $1 million. With SBA 7A loans, the cash injection or down payment requirement is 10%. That seller can actually do 100,000 of that total $1 million, or 10%, as a seller note. And what that allows you to do is put no money out of pocket down. You're using that additional money lent from the seller as that equity injection into the project. Historically, prior to just last year, they could only do up to 50%. So it had to be, if they did that 50%, it had to go on full standby till the end of the SBA loan. So depending on if it was 10 years, 15 years, 25 years, it could not be paid back at all until the end of that loan term. Now, there's a couple of different ways that it's structured. If they do 100% of the cash injection, so 100,000 on $1 million. If they do the full thing, it does go on full standby. If they do up to 75%, so 75,000 of that 100,000, it is allowed to be repaid after 24 months, and they can receive interest-only payments in those first 24 months as well. So that money can start coming in from that seller note immediately, whereas before they had to wait the entirety of that project. So super exciting for people who might be working in a facility that they want to purchase, or have the opportunity to buy but might not have that full cash injection saved up. Great way for newcomers to get into the facilities, and also for expansions too. If you have your money into your current business and you get an opportunity for a second location or a new building or something like that, you might not have that 10% and haven't been open long enough to be considered an expansion. This is a great way to get these deals done and get moving on those. All right, another thing that historically we weren't able to do through the SBA were partial buy-ins, where somebody, again, example, working in the facility could go in and buy in for 50% and become a part owner, or buy in for 25%, or whatever the case was. We weren't allowed to do those under SBA projects, but now we are. So that's super exciting. Anything up to, anything below 100% would be considered a partial buy-in, and we can do that. So if the seller wants to retain, a small percentage, or wants to still be a majority owner, but wants to have you come in as a part owner, able to do it. Historically also, the sellers were only able to stay active in that business for a 12-month period after the sale. So they could only consult for 12 months post-sale of their business. Now they can remain actively involved if they want to. So that's great when it comes to transitions, not only for, the customers, of course, but also for staffing and things like that. If there's any type of specialized licenses, I know sometimes we'll run into properties that have special use permits that don't convey once a new owner comes in. If that person retains ownership of some of that project, those remain. So definitely, tons of benefits to be able to do it this way. And also, if the seller plans to stay with the company long term, you can keep their salary, their benefits, and all of that. It won't be treated as add backs when calculating the cash flow any longer, which is just if they were leaving, those expenses would go away. They would remain if they stay on, but it definitely, like I said, has a ton of benefits. And one thing I did want to point out, this last point here, depending on what their ownership percentage is. So, with those partner buy-ins, the remaining owner may also need to guarantee the loan that you're taking out for the business. But that would be, depending on what that situation is, how much ownership they're retaining, and all of that. All right. As we talked about earlier, just to touch on this one more time, this is a big deal, those SBA guarantee fee adjustments. So, again, if you're taking out a loan under $1 million, that's 0%. So basically, you're getting that guarantee, that backing for the bank to do your project without having to put any additional money in. So honestly, historically, prior to them changing it to these adjusting percentages, it was 3.5% or 3 to 3.5% across the board. So you're looking at $30,000 on $1 million project. So it really is a big deal. And also a really big deal that they did the 1.45 to 1.7 on that $1 million to $2 million loan, because before, if it was over $1 million, once they changed their fees a little bit, it was still at that 3.5% mark. So huge savings when it comes to your overall loan totals. One thing I did want to point out with this too, when you're looking at your overall loan total, and talking about cash injections and all of that, the fees, closing costs, all of those things, appraisals, business valuations, all of those are lumped into your loan total. So that's not expected to be brought to closing, but it does impact the overall amount of the loan. All right, again, just to touch on this, the loan terms, and if you guys have questions on this, I know this can be a little bit tricky and confusing, happy to answer them. Up to 25 years. For those secured by commercial real estate. And when we talk about secured by commercial real estate, that just means the real estate that's being purchased. With these SBA projects, there could be outside collateral requirements. So, for example, if a loan is not fully collateralized by the project itself, so if the real estate and business assets of a project have a lower liquidation value than what you're taking out on the loan. So if they come back at, $800,000 liquidation value, but your loan's for $1 million, there might be requirements to take additional collateral. So that would include, personal real estate, if you wanted to put any affiliate business assets, things like that. But if there is personal real estate that you own, and you own more than 25% of that. So if you have more than 25% equity, it is a requirement to be on the loans, just, so you know. But this loan term is just based off of the real estate that is being purchased, not the overall real estate that is part of the value of that loan. All right. So, increased guaranteed dollars. So with that SBA small 7A loan, previously it was $350,000. They increased that to $500,000, which is exciting because it has a higher guarantee potential within that small bucket. So prior to that, anything over 350 only had that 75% guarantee. Now they can go up to 85. So it makes it more attractive for the bank, more backing, things like that. They also can be eligible for more expedited processing, might not need as many, those collateral requirements that we talked about can be a little bit less strict. So definitely exciting when it comes to that. It can be I never want to call the SBA process easy. It can be a little bit easier than previously. So those loans that fall in, that under $500,000 category, we can usually speed up a little bit faster, and it's a little bit less labor intensive for you as the borrower. All right. So equity injection verification. Previously, talking about their rules in the past, you needed 2 months of bank statements to prove that those funds were sitting in your account. The SBA did relax these rules. So lenders can follow their policies for similarly sized non-SBA loans within their banks. So with that, like for example, our bank, we don't require that 2-month verification. We just need to make sure that it can be transferred at the time of closing. So makes it a little bit easier. We don't need as much documentation to have those funds, to verify equity in those and things of that nature. So definitely exciting because you don't have to have, if you need $100,000 and you dip down to 99,000 1 week, the clock doesn't start over, whereas previously it did. So super exciting, makes it a little bit easier for the process and able to obtain those equity injection down payment funds. Awesome. So as far as First Financial Bank, what can we do for you with that SBA 7A financing? So we can do anything from acquisitions, both business and real estate, equipment financing, expansions, remodels, anything you want to do within your facility right now, refinances. I know that depending on when you got your loan out might make sense right now. We can do startup loans as well as working capital. So we really can do, if there's something that you're wanting to do within the pet care space, again, I specialize just in this space, and bring me the project, and we'll see what we can do for you. Thank you guys so much. I really appreciate you working with me on our technical difficulties and being here. And I am open to whatever questions you have.
Yes. All right. So I'm watching over here. I haven't seen any new questions, but I see Royal Pets was thumbs up on that partial buy-in part. That is really, that is
so
exciting news, right?
Yes.
Wonderful. Yeah. I really think that you had gone, circle back around, and with the equity information, you kind of answered a lot of my questions about really what's required as collateral. I know, myself, I've had several rounds of considering this type of thing down the road. And, so many people in the industry I talk to are looking at this expansion, and it can be really intimidating.
Yes.
So we are super, super grateful that you were willing to come on and share this knowledge with our industry.
Absolutely. I appreciate you guys having me. And yeah, if anybody comes up with any questions, in the future, I am more than happy. Feel free, even if you're thinking of it 5 years down the road, 10 years down the road, it's never too early to get started and getting those ducks in a row, and asking questions, because I can share this information, but it can be a little bit confusing once you actually get into the weeds of it, and trying to decipher all of those things, even especially with that equity piece, and navigating, what makes the most sense for you. So happy to help any way we can.
Yes, I definitely like that there's a lessened burden of paperwork.
Right? Anytime it's one less piece of paper.
It's always that too, right?
Right. Absolutely.
Oh, that is wonderful. Any other questions? Want to see if anybody has questions? Just drop them over in the comments.
So
keeping an eye out there. Otherwise, I definitely wanted to share with everyone, of course, this is PAC CEU approved. So our PAC membership out there, go ahead and copy down that CEU code to add to your list. And I'll just leave that up there for a few minutes. It doesn't look like we have any additional questions, which actually always means you did that incredible.
Well, I appreciate that. But again, I feel like some of this information is sometimes one of those things that you don't know what questions you have until you get into it. So
right. That's true. That's true. But this was a good foundation for many of us. So that is wonderful. And I will skip back over here one more time, of course, so you can see Ashlee's contact information there, her phone number, of course, and her email address over there at First Financial Bank. All right. Wonderful. I am so glad that those of you that are watching live and, of course, watching on the webinar replay could join us. I appreciate that. Again, if you have any questions about PAC, you can reach out to us on our Facebook page. And thank you so much for joining us today. And thank you again, Ashlee.
I appreciate you having me. Thank you.
Thank you so much. Bye-bye.